In today's crypto trading tutorial, we're going to be talking about how to trade a range. And what is a range? It is a resistance, just like this, and a support, just like this. And we're going to turn that green. And in a range, you see predictable movement in the price action from support to resistance to support to resistance. At support where you buy and red resistance where you sell. That's essentially the range, and we're going to be talking about how to trade a range effectively for reliable and predictable profits from your crypto trading. So subscribe to the channel, like the video if you'd like to see more crypto trading tutorials like this in the future, and let's dive right into it. So first of all, let's focus on how I like to build my ranges. I plot a horizontal level on top of the candle bodies, and understanding that sometimes we see upside wicks into this resistance, but ultimately candle bodies forming just below the resistance, upside wicks, candle bodies forming below it as well. But generally we tend to see loads of rejections at this level here, and this is essentially what a resistance shows us, the range high of this range. And on the other side, we have a support where we see lots of buy side pressure, buyers buying here, supporting the price action at this price point of around $5.57. This is where we see buyers support and buy Chainlink at this price, with downside wicking and candle bodies closing just above this support level. So we see a lot of this volatility move up and down inside the range, and the real reason that we see this is loads of buyers are buying at this level. And of course, if we see some downside wicking just below this level, then we see a lot of premium buying as well, because if you think about this range where people just buy within the range, anything just below it, below the range low support, is going to be a bargain, and anything beyond the range high is going to be where FOMOs are getting really excited about a potential breakout, and FOMO is really happy to buy into this price action before finally getting rejected. This is why essentially these upside wicks are called FOMO wicks, because this is where people join the uptrend and they're actually really offside. They're the people who join the uptrend a little bit too late and get trapped in their positions. So one way to think about FOMO wicks is that we see upside wicks, FOMOers get caught, trapped in their positions before we see rejection, and this is where bag holders essentially get formed. And on the flip side of that, we tend to see really great market buying opportunities below this range. So right over here, we have a fantastic premium buying opportunity for buyers to buy at an incredible discount, more than you'd see generally over the span of a few months, because this is a range from May 2020 to September 2023 right over here. This is a fantastic buy side opportunity whenever Chainlink revisits this green area. So this is essentially prime buy side opportunity, and this is prime sell side opportunity. And essentially the FOMOs who are really excited, and we see a lot of peak euphoria in this red region, that's exactly that. The psychology here is that we see lots of exuberance, excitement, over optimism, over confidence in a potential breakout, and Chainlink breaking beyond what is essentially this range high resistance of $7.88. We see lots of that over exuberance in this red region, and it's really important to note this psychology, because you don't want to be sharing this psychology and loads of people at the same time experience that psychology and that excitement, because after months and months and months of just sideways action, when price finally breaks beyond this range high resistance, although for a very short time, people get extremely excited and are very happy to start buying at what is essentially a premium, because they think that price is going to accelerate towards the upside without no returns. So this is the psychology that the herd mentality will embody, and that's essentially the psychology that you have to really stay away from. And charting and technical analysis is really good in just helping you denote that psychology in graphic form and stay away from it. But on the flip side of that, you really want to be a premium buyer and a bargain buyer in this market. So whenever an opportunity presents itself, this is the green area that you can use to dollar cost average into Chainlink bit by bit and premium buy, or at least bargain buy, at a fantastic discount. So that's essentially where maximum pessimism exists. That's where nobody wants to be buying. That's where people think that this range, after months and months and months of sideways action, is finally breaking down, and that we're actually going to see lower and lower prices. Just note where this downside wick was in the past: $4.75. So if Chainlink, was consolidating between $5.50 and $7.88, and then suddenly we see a breakdown in this downside wick to around $7.70, loads of people are going to be panic selling and capitulating into this current region, this green region. Loads of sellers are going to be really panicky and pessimistic and doubtful of Chainlink reversing towards the upside. This is where a lot of that capitulation is going to happen, and this is why it's very easy for buyers to step in and just prompt a reaction from this region and reverse price action towards the upside. So we see lots of interesting psychology in this region, lots of capitulation from the panic sellers, maximum fear and maximum pessimism. But of course, the saying goes, the mantra goes, extreme fear precedes financial opportunity. And by the same token, extreme greed precedes financial risk. So essentially, this is where extreme greed occurs. And this is essentially where extreme greed precedes the point of maximum financial risk, because this is where you stand to lose the most of your money, as opposed to here where you stand the most to make the most money, because by buying here, you can sell into the range high resistance. And in fact, if you want to get a bit more risky or risk taking, you can hold your position all the way up to the top of this red region. Of course, it's no guarantee that we're going to see an upside wick into as high as that level right over here. So it's really important to just understand that it's better to be a bit conservative and maybe sell at the range high resistance. Some traders would be happy to sell a little bit below the range high resistance just to be on the safe side, to be a bit more conservative, whereas others would really want to capture that upside wick in its entirety. One way to combat that, of course, is that you could be selling at the range high resistance, maybe 20% of your position, maybe then sell the remainder. For instance, you sell 20% at the range high resistance, and then 30% of your position a slightly higher price point, and then 20% again here, and then finally at the very upside wick, you sell your final 10% position. And this way you get to average out and take profit at a better average price within this range. Because if somebody sells their position in its entirety at the range high resistance, then you sell at 788, and that's a decent profit, especially if you bought around this support of 560. That's going to be approximately a profit of around, from range low support to range high resistance, that's a 40% rally. So selling all of your stack at the range high resistance and buying all of your stack at the range low support, that would yield you a 40% markup here, a 40% profit. But if you would like to sell a little bit higher each time and averaging out your position, then you sell at 46%. And then if you average out again 20% of your position, of your entire position, then you sell once again at 50%. And if you really want to get onto the higher end of these FOMO wicks here and sell maybe 10% of your overall position, the final piece of the puzzle, so to speak, you sell at 72%. So if the first investor sells at 40% at the range high, and then you sell at this $8 region, $8.10 region, and then you sell a bit here at 50%, and then here at 56%, and then here. Overall, you're going to come up with an average position that has a better profit yield of, say, 58% than the person who sold all at once at the range high resistance right over here. And the same goes on the flip side of that. If you accumulate a little bit lower than the person who bought at the range low support at this green level. If you just accumulate at, for instance, just below $5.40, for instance, then you stand to have a slightly better gain than the 40% or 42% that somebody else would have at buying at the range low. But of course, one of the best ways to get a better average position in terms of price is to accumulate a bit at the range low, accumulate a little bit below it, and then of course you can have, so to speak, stink bids at lower price levels just in case we get a capitulation wick just like this one. You can always try to get a wick like that and try to have one of those very low bids get filled, because you can see here 57% is the overall yield from that sort of low buy side order, which doesn't cost you anything. In fact, it's a much better financial choice because you get to buy more Chainlink at a lower price, at a better discount. And if, for instance, you bought most of your position at this range low, that's fine as well. But by buying here and having that lower bid, you get to average out your position from 40% potential gain to around 55, or maybe averaging it out to a 50% gain. So that sort of dollar cost averaging within these outsized regions is where we see the strongest emotionality in the market. On this side, we have extreme fear, maximum pessimism, everybody thinks it's going to zero. And on the flip side, you have extreme greed, over exuberance, euphoria here, and essentially buying in periods of extreme fear precedes financial opportunity, and buying, or at least selling, in periods of extreme greed, that's where you get to sell into the point of maximum financial risk, because holding here, you run the risk of holding at a profit and then losing all that money and gaining it, giving it back to the market once the downturn inevitably begins. And in a range, we tend to see uptrends and downtrends within this range, and these are mini uptrends and then mini downtrends. This is essentially sideways consolidation. This is technically, a range in of itself is technically just sideways price action. I'm just going to change this to orange. This is essentially just sideways price action, so non-trending price action, but even within a sideways channel like this, or a range as it is called, even within a sideways channel, you still have some trending. So if we just zoom out more to the macro perspective, this is sideways accumulation or just sideways price behavior. But if we just zoom in to this range, then it's actually trending price behavior, where we trend from range low support to range high resistance, and then reject from there and back to range low, and then back to the range high. So that's how I construct my ranges. That's how I play my ranges as well. Buying in the bargain buying territory where there's extreme fear and maximum pessimism, and then offloading those positions in extreme greed and where the point of maximum financial risk exists. And that's about it for today's video. Feel free to leave a like for more crypto trading tutorials just like this one in the future. Subscribe to the channel and feel free to check out my technical analysis course in the description down below to learn how to trade profitably, confidently, and reliably going forward. That's about it for today's video. Thank you so much for watching, and I'll speak to you in the next one. Speak to you soon.